once again. Yeah. Now, please, all the best. Start.
Yeah, thank you. Let me share my screen. I hope you can see my screen.
Absolutely fine. Absolutely fine.
Yeah. Okay. Hello, everyone. Today, we are going to study foreign exchange market, and that we will study with special reference to FRM level 1. This is the syllabus. I'm not going to spend much time on syllabus. You can see it. Okay. Now, first of all, let us understand what foreign exchange market is. In foreign exchange market, the people participate to buy, sell, and exchange global currencies. So when two currencies are involved, you say it's a foreign exchange. Now, why foreign exchange market is important? Because it helps in world trade. The foreign exchange market is biggest market in the world with daily trading volume exceeds $6 trillion. Now, foreign exchange markets trade both on over-the-counter and exchanges also. But the biggest market is over-the-counter market, wherein there are brokers and agents who decide the price of one currency in relation with others. Now let us move further and see the basics of currencies. Now, currency are quoted in two different ways. The first way is per and second one is in. Now, always remember in currency, there will be two currencies. One is a price currency and another one is a base currency. Now, the currency in the denominator will call as base currency and the currency in the numerator is called price currency. Now, how will we know which is the base currency and which is the price currency? So, the currency which is written first is a base currency. And the currency which is written second is a price currency. Now, the base currency will always have value as 1. So, we will read it as for 1 USD, we will get 0.75 AUD. Similarly, here also, for 1 AUD, we will get 0.75 USD. So, the first thing which comes, that is your base currency, and the second thing which comes, that is your price currency. Now, there are two types of quotes also, direct quote and indirect quote. Now, let us see what direct quote is and indirect quote is in the next slide. Okay. Now, we know price currency, we know base currency. Now, direct quote is quote of 1 unit of foreign currency given in units of local currency. That means if your local currency is a price currency, then that is called direct quote. And if your local currency is a base currency, then that is called indirect. Let us take an example to understand it in a better way. Let's say your local currency is euro and exchange rate is given as 1 USD is equal to 0.92 euro. Now, whenever anything is given as 1, always remember that is base currency. So if USD is base currency, EUR will be the price currency. So if your local currency is a price currency, then you call it as a direct quote. And euro is your local currency. If your local currency is a base currency, then we call it as indirect. Okay. Now we have understood what is price currency, what is base currency, what is direct quote, what is indirect quote. Let us move ahead. Now we need to find out whether this is a direct quote or indirect quote. Now USD upon INR is given. So you know USD is your base currency and INR is your price currency. So it's given as INR upon USD as 82.45. Now INR is your price currency and you are an Indian investor. So therefore, this is a direct quote. Okay. Okay.
So if we
Let's
move
move.
back to the previous slide,
Yeah.
I'm actually trying to understand. This is interesting.
Yeah.
One more slide back, please.
Yeah.
So here you said the currency that comes first is the base currency, right?
Yes.
One slide ahead, please. And here INR USD, like you are writing INR first, but you said it is a price currency, so I was
No,
confused.
no. INR is a price currency. So look, USD is written first. So USD
Okay.
is base currency.
Got it.
INR is
Okay.
written afterwards. So INR is a price currency. Sorry.
But
But
you wrote INR USD rate 82.45,
no.
saying
This,
INR first.
yes. No. Look, this is one way of writing, and this is understanding. Understanding means one USD, from one USD, I'm getting 82.45 rupees. So this quote and this writing this quote is similar.
Okay.
These are similar way of writing things. So when you say USD upon INR, so I will write USD in the denominator and INR in the numerator.
Okay.
You got my point?
Yeah. So the one on the left is the conventional way, formal
Yes.
way, but on the right, it's for understanding.
Yes, for understanding. It's people understand in this way, but people write in this way.
Okay.
Yeah. So this is more of a mathematical way. Yeah. Should I move ahead?
Yes.
Yeah. Okay. Now let us look here. AUD upon USD. So basically here AUD is a base currency. That means for one AUD, I'm getting 0.75 USD. Now, if AUD moves from 0.75 to 0.85, has AUD appreciated or depreciated? That's the question. Now, we have not seen appreciation and depreciation of currency, that we are going to see it. Now, always remember, it's easy to understand appreciation and depreciation of currency in terms of base currency. And it's exactly opposite will be for price currency. So we will always try to calculate appreciation and depreciation in a form of base currency, and then we will reciprocal it to say for price currency. Now, AUD, USD, so USD will come, AUD will be your denominator. It was 0.75 and now it has moved to 0.85. Now, Always remember all these codes work for base currency. Now, you are getting 0.75 USD now, and after 1 month, you will be getting 0.85. Or last month you were getting 0.75 USD for 1 AUD. Now you are getting 0.85. So you are getting more USD for the same AUD, that is Australian dollar. That means which currency is getting stronger? The base currency is getting stronger because you are moving from less value to higher value. So base is getting stronger. Therefore, AUD has appreciated because the value is getting more, value is increasing from 0.75 to 0.85. That means for 1 AUD, I was getting 0.75 USD. Now I am getting 0.85 USD. That means the purchasing power of AUD has increased from 0.75 to 0.85. Therefore, AUD has appreciated. Now, when we say AUD has appreciated, what will happen to USD? USD will exactly be reciprocal of AUD. So USD will depreciate. So when base currency appreciates, your price currency depreciates. So this, in this example, when AUD moves from 0.75 to 85, AUD has appreciated. Let's see. AUD has appreciated and therefore USD has depreciated. Let's move ahead. Okay. Now, after understanding of base currency, price currency, let us understand what is spot rate and forward rate. In foreign exchange market, you will have rates of any currency for today, after 1 month, after 15 days, after 6 months, after 1 year, after 5 years also. And some brokers might give you rate for more than 5 years. So the rate of any currency pair today is called spot rate. So that is today's rate. And forward rate is the rate of the currency pair in the future, which is fixed today. So I will say, I want to purchase USD after 6 months. So they will give us a rate, let's say 85. What does that mean? That USD is to INR is 85 for, let's say, 3 months. What does that mean? That no matter what's the rate in the market, after 3 months, this person, the bank, the agent, will give me 85 rupees for 1 US dollar. But when? After 3 months. So this rate, which we are going to get after 3 months, is called forward rate. And that rate is not linked with the spot rate after 3 months. So after 3 months, the spot rate might be 87 or might be 82, but he will give us at 85. But the amount will be fixed. So he will just give us for 10,000 US dollar or whatever the amount which we decide today. So forward rate is the rate after a certain amount of or certain period of time for a prefixed price and for a prefixed amount. That is forward rate. So let's move ahead.
Yeah, I
Now,
have one question. What is
yeah,
called in the banking today, Tom and spot? What is that?
sir, I could not hear you. Can you repeat the question, please?
What is called in the banking today, Tom and spot? Is it something different?
Today, today,
Tom and spot.
Tom and Spot. I am not sure about
Okay,
Tom
no
and
issue.
Spot.
No issue. Well, this,
Yeah,
this is, I think, with the as per settlement. If settlement is done today, it is today. If settlement is done tomorrow, it is Tom. If settlement
okay.
is done on the third day,
And
then it is spot. So,
Spot.
okay, no
Okay.
issue.
No, I was not knowing this. Thanks
No,
for
no issue. No issue.
yeah, letting me. Yeah. Now, as I have already told you, most of the currency exchange takes place over the counter. When I say over the counter, it's not exchange traded. That means there are agents, there are brokers, and there are banks who helps to exchange the currency. Now, if they already know that okay, we want to sell USD, they will try to give some rate which might not be good for us. So, whenever we try to ask agent for a rate, they give two rates. One is bid rate, another one is ask rate. Now, what is bid rate? Bid rate is that rate. Just a second. Okay. Bid rate is that rate at which the agent purchases the currency from us. And ask rate is that rate at which agent sells the currency to us. Now, let's take 82.5, 82.7. So, this is bid and this is ask for USD INR pair. So, if you want to purchase USD, you will have to pay this much because he will sell at higher rate. And if you want to sell, you will get lower rate because he will buy at this rate. And the difference between the bid and ask is called spread or bid ask spread. I'm repeating again, bid is a rate at which dealer will buy from you. So at which you will sell. So this is agent or a dealer, and this is, let's say, retail. Ask is a rate at which agent will sell and at which you will buy. So the difference in bid and ask is the commission of your agent, broker, and bank. And that commission is called spread. Now, let us take an example. This is a bid ask rate of AUD to USD. Now, 0.70 and 0.7010. Now, always remember AUD is your base currency and USD is your price currency. Now, all these codes are based on your base currency. Now, a dealer will buy AUD from you at 0.7. So this is bid rate. And he will sell AUD at 0.7070. That is ask. So always the first rate which is written is bid and the second rate which is written is ask. Now, you can change this. You can make USD as your base and AUD as your price. So you can make another pair from this. Let's say USD is to AUD. Then what you will have to do? You will have to do 1 upon 0.7000 and 1 upon 0.7010. Now, this value will be lower and this value will be higher. So, this will be your new bid and this will be your new ask. So, you can write the same pair by changing the price and base currency. But always remember, whatever is of lower price, that will always be bid. Whatever will be at of higher price, that will always be an ask rate. And the difference between bid rate and ask rate is spread. Now, generally, spread is given in percentage terms. And the formula for percentage spread is ask price minus bid price upon mid price. Now, here in this example, 0.7010 minus 0.7000, that is 0.0010, divided by midpoint. So average of tools bid and ask is 0.7005. So percentage spread came out to be 0.143%. So that's how you calculate percentage spread. Higher the spread, lower is the liquidity. That we will see in our next slide. Okay. Consider 6 months forward exchange rate, quote of US currency dealer. So GBP to USD. So GBP will be your base, USD is your price currency. This is your bid and this is your ask. You can even write it like this. Now, this rate is a forward rate because it's considered 6 months. Okay. Now, you can calculate the spread, but from this side, I'm going to tell you 2 things on what parameters the spread depends. Now, spread depends on market condition. If there is fear in the market, the spread widens, so spread increases. They try to cover their risk, or agents try to cover their risk with the help of spread. It also depends on dealer position. If dealer has a lot of liquidity or a lot of currency pair with him, so he will try to lower the spread. If there is large volume, the spread will be less. Length of the forward contract. If the length is higher, the spread widens. So spread depends on these parameters. And you will need to keep in mind that how spread or how these parameters affect the spread. Let's move ahead. Okay. Now, this is a simplest example to understand how currency exchange rate works. Now, a US firm is obliged to make future payment of Swiss franc 100,000 in 60 days. To manage its exchange rate risk, firm contracts to buy Swiss franc 60 days in the future at 1.7530. So this is your forward rate. The current exchange rate, spot rate, is also given. Now the 2 questions are asked. The first question says, how much would US firm gain or lose on its commitment if at the time of payment exchange rate is 1.65? And the second question is, the exchange rate is 1.8. Now, let us try to solve this in a Excel sheet. Okay. I hope you can see my Excel sheet.
Yeah, absolutely.
Yeah. Perfect. So we are talking about 100,000 Swiss franc, 60 days from now, wherein the future rate is 1.7530. That is USD to CHF. The question is, what will happen if the spot rate after 90 days, 60 days, sorry, is 1.6556. This is your calc. Now, let us understand this first. So, forward rate CHF upon USD is given as 1.73. What does that mean? For 1 USD, you will be getting 1.73 CHF. Now, you want 100,000 CHF. So, for 100,000 CHF, how many USD you will be getting? So, it's 100,000 multiplied by 1 divided by 1.73. Simple cross multiplication. And by fixing your forward rate, you will be getting 57,803 USD. Now, let us see if you do not fix your USD and after 3 months the spot rate becomes this. Now, again, write the same thing. CHF USD 1.6556 and for 1 USD. So for 100,000, how much USD you will require? So 100,000 into 1 divided by 1.6. And you would have required these many. So what's your profit? Your profit is nothing but this value minus this value. You require these many less US dollars because you have fixed the rate. $60,000, $57,000, is it the same? Let me just cross check, please. What's happening? Just give me a sec. 1.6556 and the future rate is 1.7530. Okay, now it's correct. Yeah, here it was right. I did a mistake here. So your profit is 3355. Now let us see if you change if you change your interest rate to 1.8250 or your exchange rate after 3 months, if the exchange rate after 3 months is 1.8250, how much will be your profit and loss? And you will see you will suffer a loss of 20 to 50. 20 to 50. Okay. So that's how you need to solve such type of questions. Let us move ahead and understand what is forward discount and forward premium. Now, if the forward, now if the forward price is less than spot price, you will call it as forward discount. And if forward price is greater than spot price, you will call it as a forward premium. And this, again, we will always look from base currency point of view. So if base currency is expected to depreciate, we will be in forward discount. If base currency is expected to appreciate, we will be in forward premium. So let us see an example for forward discount and forward premium. Now, assume that a 90 days forward rate for CHF to USD is this and spot rate is this. Determine if CHF is trading as forward premium or discount. Now, first of all, look for base currency. So your CHF will be your base currency and USD will be your price currency. Now, the current spot rate is 0.445 and the forward rate is 0.45. So here, the forward price is greater than spot price. So when forward price is greater than spot price, you are in premium. And when you are in premium, your base currency, so which is base currency? CHF. CHF will appreciate because it's increasing. From 0.44, it is going to 0.45. So always base currency is increasing. So let us see. Yeah. So you are in forward premium and CHF is appreciating. So when CHF is appreciating, always remember the other currency, USD, will be depreciating. And how do you calculate forward premium or forward discount? So there's a formula which is written in next couple of slides. So forward rate minus spot rate upon spot rate multiplied by 360 days divided by number of days for which the forward rate is given. And that's how you can calculate annualized forward premium or discount. We will see the formula in next slide. Yes. Okay. Now, how do we calculate forward rate, or how will we decide that, okay, this is the right forward rate and this is not the right forward? Now, the basis of forward rate calculation is interest rate parity, which says that the exchange rate, sorry, the pen has stopped working. Yeah. Interest rate parity says that exchange rate of any two countries, let it be USD AUD or any two countries, is dependent on the exchange rate of two countries, is dependent on their interest rate. And it's saying that the currency with higher interest rate will depreciate, and the currency with lower interest rate will appreciate. Okay, so the forward rate, so let's say the rate in Australia is 12% and rate in USD is 8%, then the Australian currency will depreciate as compared to US currency. That's the basis of interest rate parity. Now, what they are saying is that the relationship between forward rate and spot rate of any currency is dependent on the interest rate of these two currencies. So, which currency should we take in numerator and which currency should we take in denominator? So, always remember the base currency should be in denominator and the price currency should be in numerator. So, the interest rate of price currency should be in numerator and the interest rate of base currency should be in denominator. So, from forward rate and spot rate, we can calculate, we can calculate the forward rate of any currency pair based on the interest rate of those two countries. Now, when I say interest rate, those are nominal interest rate and not the real interest rate. Now, we will take an example and understand that in a better way. But here is another example which is derived from the same formula. So, just do -1 on both the side and you will get this formula, which is widely used as a formula for interest rate parity. That is, spread of forward rate minus spot rate upon spot rate is nothing but changes in currency upon 1 plus base currency. So that's the idea of interest rate parity. I'm repeating again, interest rate parity tells us that the depreciation and appreciation of currency pair is dependent on the nominal interest rates of the currency pair. The currency which has higher interest rate will depreciate more as compared to the currency which has lower interest rate. Let's take an example to understand this. Now, interest rate in US is 9%. Interest rate in Euro is 12%. The spot exchange rate is 1.30 per Euro. So per Euro is base currency again here. And calculate expected exchange 1 year forward rate. So you need to calculate forward rate. Now, you know forward rate upon spot rate is equal to 1 plus RA upon 1 plus RB. So forward rate is nothing but spot rate multiplied by 1 plus RA upon 1 plus RB. The question is, what is RA and what is RB? So Euro is base, so Euro will be in base and USD will be in price. So spot rate is 1.3 multiplied by rate in US is 9%. So 1 plus 9% comes out to be 1.09 divided by 1.1. And the answer will be less than 1.3. I do not have calculator in front of me. So let's see the answer. So the answer comes out to be 1.265. Now, the spot was 1.3. The future was 1.265 or forward rate was 1. And the base is euro. So euros spot was 1.3, forward was 1.26. The rate is reducing, so euro is depreciating. When euro is depreciating, USD will appreciate, because that's vice versa. Yeah, this is of the highest difficulty level, which it can go for level 1. So this is for arbitrage. Now let us understand what arbitrage is. Arbitrage is risk less profit generated when there is a difference in pricing of same commodity at two different places or at two different times. Now, the spot rate is 1.3 and the forward rate is given as 1.35. Now, first of all, we have to determine whether profitable arbitrage exists. And if it exists, how to take benefit of it. Now, let us see if it exists. Now, with the help of interest rate parity, we can calculate the forward rate as spot rate multiplied by 1 plus R A upon 1 plus RB. So spot rate is 1.3 multiplied by per euro, so 1.08 divided by 1.06. So this value will be more than 1.3. So let me see the value. It's coming out to be 1.32 something. Now look, our calculated forward rate came out to be 1.32 from interest rate parity, and the dealer is giving me the rate of 1.35. So the question is, does the profitable arbitrage exist? Yes, the profitable arbitrage exists. Now, how you can take benefit of it? Now, in order to take benefit out of it, the simple rule of thumb is sell what is dearer, buy what is cheaper. Now, here 1.35 is higher than 1.32. Therefore, I will sell forward base currency, that is euro, and I will buy spot euro. Now, let's take an example and do this. So I need to go to Excel sheet to do this. Let us understand what's happening here. There's a difference between calculated forward price and dealer given forward price. And we need to see how we can do arbitrage out of it. So just give me a sec. Let me go to it. Yeah, here. So let us see, USD is 8%, euro interest rate is 6%, spot rate is 1.3, and even forward rate is 1.3. I only wanted this. Yeah. Let us calculate the forward calculated rate. Spot rate multiplied by 1.08. I'm doing it directly. I hope and this 1.06. So forward rate is 1.3245. Now given forward rate is higher, so you sell forward euro by spot euro. So how to do it? Take a loan of $100. If you take loan, you will get it at 8%. Now, the spot rate, let's write it down. USD upon EUR is 1.3:1. So if you take a loan of $100 today and you buy spot euro, so if you purchase euro today, how many euro will come to you? So let's say you have 100 USD. How many euro will it come? So 100 multiplied by 1 divided by 3. You will get 76.92 euro for $100. Right? Now, this 76.92 euro, I will invest at 6% for 1 year. So let's write it down. Today, USD euro. So for 100 USD, you are getting 76.92 euro. Let's say after 1 year. Let's see what happens after 1 year. You have invested this 76.92 for 1 year. So you will get 76.92 into 1.0 because interest rate of euro is 6%. So for 1 year, you will get 6% interest. So after 1 year, you will get 81.53 euros. Now, you already sold forward. So after 1 year, you will get this rate. So let us do this again. USD upon euro 1.35. And now you have 81.53. You need to convert it to USD. How do you do that? 81.53 into 1.35 divided by 1. You are getting 110 USD. But you have taken loan of 100. So after 1 year, you will have to pay back interest on 100. How much is the interest rate? 8%. So after 1 year, you will have to pay how much? You will have to pay 108 USD. How much you are getting? 110 USD. So how much profit you are making? You are making profit of 110 minus 108. 0.07 US dollar for zero investment. Now you could have taken a loan of 1,000, 10,000, lakh, million, billion, and you could have increased your profit substantially. Please understand this profit is risk-free profit because you are already fixed your rate for 1 year at 1.35. And because this rate is different than your forward rate, therefore you can earn riskless profit. If your forward rate is same as calculated forward rate, you could not have earned any riskless profit. So let's go back. Let's see here. Same thing, and you have earned 2.0 something as your riskless profit. What we have done till now. Now, this is what the exchange rate risk speaks about in foreign currency. There are certain topics which I have not covered today. Maybe transaction risk, translation risk, more of a theory. What is the difference between covered and uncovered interest rate parity? That we will see in our next lecture. Now, based on interest rate parity, there are certain things which you need to look for, like real rates. Now, it has been found that interest rates are affected by inflation also. And only inflation comes between nominal and interest rate. So, the basic idea of purchasing power parity is that, just a second, is that the identical basket of goods will have the same price in different market or in different countries. So, if taxes are ignored, if transaction costs are ignored, then one apple in USA should cost equal to one apple in India. That's the basis of purchasing power parity. Now, because these should cost equal, as per purchasing power parity, if there is a change in this, our exchange rate might get impacted. So, rather than exchange rate, we will say that inflation impacts interest rate. And when we subtract the inflation from our interest rate, we will get real inflation rate. Now, how do we calculate real interest rate by using inflation? That we are going to see in next couple of slides. Now, if you want the definition, nominal exchange rates are those exchange rates which are unadjusted for changes in inflation. And real rates are those rates which are adjusted for changes in inflation. Okay, let us see here. We are supposed to calculate real exchange rates. And our nominal exchange rate are given to us. The formula is real. Give me a minute. Yeah. So real exchange rate is nothing but nominal exchange rate into consumer price index, that is inflation. We calculate the inflation from consumer price index itself and consumer price index of both the currencies. Now, always remember, if this is y by x, this will be exactly opposite. This will be x by y. Now, consumer price index is nothing but prices of all essential commodities of that country. So let's say in India we have a list of, let's say, 50 commodities. Couple of years back, you had the price of Murphy radio in that, but now they have changed. So 50 commodities, including let's say some electronic, some food items, and all that. If last year, let's say, its price was 1,000, this year its price is 1,100, then your consumer price index is nothing but 1,100 minus 1,000 upon 1,000 into 10, just to convert it into consumer price index. That is into 100. Sorry, that is 110 upon 1,000 into 100, and that's how you calculate consumer price index. Now, with the help of consumer price index, we can calculate inflation, and then we can multiply it by nominal exchange. Let us take an example to understand it in a better way. Now, dollar-euro exchange rate is given as 1.42 per euro. This is your nominal exchange rate. The price of Eurozone consumption basket is 100 euro. Price of US commodity basket is $142. And we are supposed to calculate real exchange rate. Now, per euro, euro is in denominator. So, let us calculate this nominal exchange rate into consumer price index. Consumer price index. So, as euro is a base currency, consumer price index base currency will come up and this come down. So 1.42 multiplied by US base is euro. Euros is 100. So multiplied by 100 divided by 142. So the exchange rate comes out to be 1. That's real exchange rate. Even though the nominal exchange rate is 1.42, when you consider inflation, your real exchange rate is 1. Now, similarly, if dollar-euro exchange rate increases to 1.52, but the prices remains the same, what will happen to real exchange rate? Point 100 divided by 142, and your real exchange will increase to 1.07. So that's how you can calculate real exchange.
Yeah, thank you, Rishikesh.
We generally,
Yeah,
yes.
yeah, it's so
Thank you
nice,
very
so
much.
nicely explained
I have taken a
everything.
lot of time.
So nicely explained every concept.
I am not sure that
Thank you very much. Yeah.